All right, let's talk Hershey's. Their latest earnings report just dropped, and on the surface, it looks like a total home run. But if you dig a little deeper, there's this really fascinating dilemma brewing that could, honestly, change the whole company's future. So let's get into it. So the first thing you have to see is this number. The day they announced their earnings, the stock just shot up, almost 9%. I mean, that is a huge vote of confidence from Wall Street. So you gotta ask, right? What exactly did investors see in this report that got them so pumped up? Let's break it down. Okay, so first up, let's look at the headline numbers. And honestly, the fourth quarter looked fantastic for Hershey. I mean, they didn't just meet expectations, they totally crushed them. And we're not talking about a small beat here. Wall Street was looking for just under $3 billion in revenue, right? Well, Hershey came in with over $3 billion. And it was the exact same story with profit. They blew past the estimates by a solid 31 cents per share. So yeah, people are definitely still buying their snacks. No question about it. But, and this is a big but, all of that strong sales performance was actually hiding a huge growing problem right at the very core of their business. So even as they were selling more and more stuff, the cost to actually make all that chocolate was getting crazy expensive. It was just eating away at their profits. And this is the number that tells the whole story. A drop of 650 basis points in their adjusted gross margin. Now, for anyone not familiar with that term, that is a staggering 6.5% drop. That's how much less profit they're making on every single thing they sell. It's a huge deal. You see, gross margin is basically the lifeblood of a company's products. It's their fundamental profitability. And Hershey's was shrinking fast. So the big question is, why? Well, the answer comes straight from their report. They called it unprecedented cocoa inflation. The price of cocoa, their number one key ingredient, has just gone through the roof. And this is the real dilemma at the heart of our story. Okay, so with their main product, chocolate, under so much pressure, how in the world did Hershey convince Wall Street they had a solid plan? Well, it all starts with this brilliant strategic pivot they've been working on for years: salty snacks. Get this, in the fourth quarter alone, their salty snacks division in North America grew net sales by an incredible 28%. I mean, that's not just growth, that is an absolute explosion. And if you look inside that division, some of their brands are just on fire. Take Dot's Pretzels. Their retail sales jumped 21%. That makes it one of the fastest growing brands in the entire salty snack category. It's a breakout star. And what's wild is that all of this investment and all of this growth has kind of quietly turned Hershey into the third largest salty snack company in the entire US. They've become an absolute powerhouse. But a booming salty snack business isn't quite enough on its own. The other part of Hershey's plan is to get super aggressive with new products and a huge marketing blitz to just drive excitement and demand for everything they sell. And they are rolling out a seriously impressive lineup. We're talking about scaling up the Reese's Oreo collaboration, which everyone loves. They're launching gummies with Shaq. And they even have a spicy version of Jolly Ranchers called Heatwave. It is all about creating buzz. And listen to this, they are putting some serious money behind it all. They're boosting their media spending by double digits, and they're planning activations around 10 huge cultural moments. Think the Olympics, March Madness, just to make sure absolutely everyone sees these new products. So, okay, they've got a plan to drive sales. That's clear. But what about fixing that huge margin problem we talked about? Well, that brings us to the financial strategy, the part that really got investors excited. The plan here really has two parts. First, they're going to raise prices by about 10% to help fight back against those high cocoa costs. And second, they're going on an aggressive cost-cutting mission, targeting hundreds of millions in new savings from their operations. And this is the promised payoff. What they're forecasting for 2026 is solid sales growth, a huge recovery in that gross margin, and a massive, 30 to 35% jump in adjusted profits. This is the future vision that caused that stock to pop. And to top it all off, the new CEO, Kirk Tanner, came out and basically projected total confidence. He's sure the company can navigate this whole cocoa crisis, get their profitability back on track, and just keep growing for the long term. And so that really brings us to our final thought here. Hershey's identity, for as long as any of us can remember, has been chocolate, right?
But with these historic price pressures, their salty snack division is really proving to be the new engine for growth. So it leaves us with this really fascinating question about the future of this iconic company.